Welcome to this, and it's part 5 of 5. Just a quick reminder of the course aims. Hopefully, we're well on the way here in achieving these. Understand terminology and the tools, the specific instruments used to allocate risk and reward in construction contracts, especially under the NEC family of contracts, and from the big to the small picture. And we're getting towards the small picture so that if you are involved, you can intelligently contribute to the development of good contract strategy. I should perhaps have said earlier, if you're on the contractor side or the consultant side on the receiving end of these contracts, so that you can look at them and know what the hell you're getting into and what your liabilities are and everything like that. As well. So in terms of the overall program, we're down there. And it's going to be tight, but we're finishing off today. We're thereabouts, but we're getting tight. So what are we going to do? We're in the objectives, agendas, because there's two. Ground rules again. Review of last time. Well, actually, that should be the wrong way around. No, it is the right way around. A quick review of what we covered, not necessarily what the content. Then a quick look at incentive plan design. And that's because effectively the incentive clauses we went through last time, they're an empty vessel. And by that, I mean the words are there for you to add in the incentives, but how much, against what, etc. That's what will make it fly, any incentive plan fly, not what we've covered so far. So 2 slides on that. We'll then go through the X clauses. I've arranged them in what seems to me a logical flow rather than a numerical flow, if you like. We'll then look quick at UK specific clauses, the Y brackets UK 1, 2 and 3s. The Z clause, which is the additional conditions of contract, a few tips on adding or subtracting compensation events, and then a final review. So ground rules. Oh, no, we're missing them. Are we missing them? Have I... hang on, let's see. Yes, I am missing ground rules. So you know them, I think. So ground rules, I would be delighted if somebody turned on their camera. Do ask questions if you're shy, or stick up your hand to ask questions, your virtual hand. If you're shy, just put it in the chat. I will get my chat side panel up. So if you've got a question there, put that in there, and we'll crack on. So what have we done? Well, we did last week, we did the adjudication or the dispute resolution contract. So adjudicate W2 is the one which complies with the UK Construction Act. So adjudication is a cheaper, simpler, less proceduralized form of and quicker form of dispute resolution. W1 is the one for use outside the UK if there is an existing country legislation which does similar things. So Hong Kong has it, I think New Zealand has it, I think Australia has it, and Ireland has it, etc. W3 is the dispute avoidance board, which you cannot use in the UK in its unamended form. But which I think is it's a disappointment that there isn't a UK version to slot in at the start of the adjudication procedures, where in the UK instead of the senior representative. In terms of, we then looked at bonus for early completion and delay damages, which are 2 sides of the same coin or whatever. It is relative to the completion date, which is typically put back by compensation events, but can be brought forward. Where does completion, when the contractor actually finishes the work, when do they achieve that? And it's done on a per day basis. Related to these is sectional completion, because you can specify damages for sections if you use this and then specify the sections. On this slide, we looked at low performance damages, and although it's a little bit out of sequence, we also looked at multi-party collaboration, and the reason we did that is because it can have positive incentives, based around performance of the overall project, typically, where individual incentives are added onto the individual contracts to give positive incentivization. And then there's other arrangements around that for collaboration between the parties to a project, but they're individual contracts, unlike the two other, or unlike the alliance contract, I should say. And does anything else appear on that? Oh, we looked at limitation of liability, I think the last thing on this slide, and how the total liability and the different forms of cap on different types of liability, but how the total cap or total liability isn't really the total liability. And on this slide, we looked at key performance indicators, so positive performance over and above the contractual minimum, if you like, for non-time related aspects. And if we look at us, we looked at the climate change, which you could argue is unnecessary because it brings into one, if you like, key performance indicators, low performance damages, but adds a few features. Yeah, if you're being nice to it. My main comment is it's a shame it's called climate change, because it could be used for social value, etc., and so on. So that leads us into, did we do another one? Yes, early contractor involvement, which we've done quite a while previously. This is two forms. The one where you have stage one on a cost reimbursable contract, and then it becomes a target cost contract, or where you have a stage one on cost reimbursable contract as the other version, and then it leads into a cost reimbursable contract. So no compensation events, but there is a higher level budget, and any savings on that budget, and that can include it includes what would traditionally be compensation events. It includes potentially client costs elsewhere in the project, and any savings, and its savings only, are shared in pre-agreed proportions. Any overrun, it's on that budget, it's all on the client. So that's the quick run through. Quick view of incentive plan design. So the definition of a project, if you look at the Association for Project Management's definition, is something like a unique endeavor. Well, if it's a unique endeavor, it implies that to some extent each incentive plan has to be unique, which is not to say you can't base it on other ones which have worked or are similar, etc. And I'm all for not reinventing the wheel, but it does imply that it's got to be unique. So you could have a £10 million project and a £5 million project with exactly the same aims, objectives, measures, whatever it is, strengths and weaknesses of the parties, risks, etc. Just the fact that I think I said one is 10 and one's 8 just would imply that you would reduce the level of bonuses and damages on it. It's extremely rare that any project will have all of the same things going for it. So you'll need to tailor it and make it unique to be effective. You at least need to give that consideration. Okay. So I think when I started talking about contract strategy quite some time ago, I said what I see is often imprecise objectives, politically correct objectives, which when challenged, actually people often go, oh, well, not really. Well, what I mean is, and so on. So it is define those objectives, genuine objectives, not what people think they are. That can take a bit of while to get out. And then how important are they relative to each other as the employing the client party? Because that puts an indication of how much weighting to give them. And what you want to do is basically select the critical few objectives which matter, not try and incentivize everything, because then people will just be chasing around too much. Develop measures of performance which accurately reflect your objectives yet are easy to measure, and that can be they can be if you like, go against each other, right? And there is, what is it? There's one Hunter's rule, is it something like that? Whatever you measure becomes the objective. So you want those to be in alignment, but you also want them easy to measure, because what you don't want is arguments over have you achieved that, has the contracting party achieved that objective. You want to be able to clearly say it's achieved that objective. And if you're doing a sort of scale, don't have too many. If you had 1 to 10, then you might be arguing over, you know, the transition points. If you've got 1 to 4 and they're in groupings, you're much less arguing over it. Start from and that's part of the easy to measure bit. Start from a realistic base. When I did my research into incentive mechanisms, every bit of literature pretty much said the starting point needs to be realistic. And let's do it in extremis. If the starting point is too easy, it's a certain, then the contractor's going to be making you know, easy money. Basically, they're going to be getting a bonus for not doing much. If, on the other hand, the starting point is too hard, it's exceptional performance, the contractor might look at it and say, I'm never going to achieve that. I'm not even going to try. Yeah. And if it's negative performance that you're motivating, or with damages, they might not even bid, or they'll add in lots of risk into their prices. And then this is one: balance the incentive plan so that the rewards for pursuing the different objectives match the value added and weighting of the client's objectives, as well as take into account risk and who has influence over it. So let's say we've got, for that 5A, let's say I'm a client. I've listened to John and I've said I'm only going to have 2 incentives because there's 2 things which are really important to me, and the more I get of them, the better. But this one is really important, so I'm going to put an incentive on my £1 million contract, which could, if they achieve it, could be worth £100,000 to the contractor. And yes, we graduate it, so you know they could get 1 million and £25,000 or 50,000 and so on. But the contractor looks at it and goes, yeah, but to achieve that level of performance, or each unit of performance above the contractual minimum, I have to spend more than the incentive. Therefore, I'm not going to pursue it. Let's say, I know it's power consumption or something like that per over the whole lifetime. But the other incentive, relatively little amount is put on it. Let's say £20,000, and the contractor, and it's stakeholder management, and the contractor goes, well, actually, I can achieve that easily. Stakeholder management and how it's managed is keeping people informed and happy. I actually don't need to put any extra people on that. It's going to cost me nothing to do that, but I'm going to make sure that they do it, because, well, £20,000 is an extra 2% profit, and I only normally make 2 or 3% profit on my jobs. So actually, that's really worth it. So as a result, the contractor then pursues stakeholder management absolutely full on, to the exclusion of the other one, because it costs them more to do it than they get an incentive. And meanwhile, the client is going, but I'm really incentivizing the first one really heavily, and you're doing nothing to it. So you need to balance that out. And you need to take into account risk and who has influence over it. And I would say, if a party doesn't have, shall we say, significant influence over it, and ultimately what you really want, if you can divide the work up into packages, is control. But we don't live in a perfect world that way. Significant enough influence for them to go, yeah, I can go after that. What you absolutely don't want to do in terms of damages is allocate something to or a damage to someone when they don't have control over it, because they'll just look at it and go, that's a gamble. You know, I'll just add in some money for a gamble, or I won't bid. Now that I've put this in sequence, but you've got the following considerations, and I'll actually go to the second one first. One of the things that my research found years ago was that incentive plans where they were jointly developed, and that doesn't necessarily mean the client doesn't put forward their ideas, but they were discussed, etc., with the contracting party, were far more effective than client imposed ones. Because you got the understanding, you got in understand the contractor got the understanding about what the client was really after and what mattered. The client understood the contractor's cost drivers and how they could go about achieving it. So it promoted realism, it imposed understanding, and it imposed joint ownership, especially of those bonuses. Going back to the top one, use a combination of positive and negative incentives. In fact, other research indicated that negative incentives, damages, if anything, have a negative effect on project performance. And I won't give my research, I'll give a conversation I was having with probably about a month ago with someone. And on this point, he absolutely agreed. And he said, when I was in Saudi Arabia, we did a trial. We let 5 projects with positive incentives only and 5 with negatives. In the ones with negatives incentives, people would come into the meetings to defend their position and basically put the blame on the other party, to put the liability on the other party or escape their liability. In the ones with positive incentives, from the word go, the whole atmosphere of meetings was, how can we solve this problem? How can we overcome it? And that was reflected in the results of the project. Okay, as in the ones with positive incentives perform better, in time, cost, quality, etc. I say use a combination simply because if you don't have negative incentives, damages in the contracts, then you're going to have time at large, for instance, or the cost at large. And very few contractors would enter into a contract on that basis, as in it's open-ended. So it is quite common to see delay damages at £1 a day or something like that. The upside of that is having positive incentives at sufficient to motivate the contractor. Going down to here, longer term projects, consider the use of milestone incentives. So projects during the contract. And the reason for that is that we are like children. We want to be rewarded close to the time that we do good performance. So that could be meeting time milestones. Well done, you've met it. But it could be also subjective ones, which are more around degree of cooperation, following procedures which you believe will give good results, etc., and so on. If using those subjective or qualitative measures, then the best way to decide it is you need someone who's a bit or people who are a bit dispassionate from it. So off-site management, typically cleaners, client staff, but in consultation with the site team and the contractor. There is a big temptation as a contractual and incentive geek that I am to go, and this is of any expert, to come up with something which is really complicated and clever and whiz-o-whiz. The problem with that is unintended consequences. And I've seen this time and time again when you look at complex incentive mechanisms. Complexity does, first of all, it, as I said, unintended consequences, but also, there can be so many things that people have to go through and hoops that people have to jump through. And if I achieve this, then I have to achieve that, that actually, it fails to work. And I know, I was helping a consultant look at an alliancing opportunity. And on the downside, the negative incentives, or the upside, there were about 3 hoops they had to jump through before they actually got any incentive. And they basically said there is asymmetric risk. There is too much downside risk, or far more likely that we will have downside, because if we do negative performance in one aspect, it's downside, but we have to do 3 aspects of positive performance to get the upside. So asymmetric risk. we're not taking part. We believe we'll lose money on the, or we're more likely to lose money. And you can do all the geeks like me can do absolutely the best possible incentive, good stakeholder management to arrive at the objectives, weighting the incentives, etc., and so on. But if no one knows about it, who's delivering it, it's not going to work. So it needs to be communicated out to the people who are doing the work in order to change their mindset, change how they behave, which includes focusing on what matters to the client, which should be what matters to the contractor, because that's how they make more profit. Okay, so just a quick stoppage there. I'll flick back to this other slide. In terms of incentive plan design, any questions? As I said, the contract through all its secondary options gives you the tools to put in place an incentive plan, but you've got to do the work to make it an intelligent incentive plan. So any questions on what I've said on this slide or on that slide before we move on? No, gone, right. Okay, so so why don't I put this up here just as a reminder that everything I think we look at is effectively we're looking at principles of allocation of risk and sharing. So a statement I said very early on was contracts allocate risk and reward, or risk, and in doing so they allocate reward. That could be negative reward through damages. It could be it just costs you a lot more longer. It could be positive risk, if you like, opportunity. So view it through that slant. So cracking on. Oh, and we've got to consider risk attitude. First four of these, I think. X1 is price adjustment for inflation. X1 is for, so under option A and B, it applies to, well, under all options, it applies to the prices. So under options A and B, that's what is paid to the contractor as the contract progresses. So a activity which is bid and accepted at £10,000, if it's completed at the end of a year, the first year of the contract, and inflation is 10%, the contractor will get paid £11,000 for it. So that's how that works. Okay. Under options C and D, the prices is the target against is the fulcrum around which the incentive or the pain gain share mechanism operates. So it only comes into play at completion. So when the contractor completes the work, because that's where the reconciliation between what the contractors spent plus their fee and the prices comes into play. So it's really the total of the prices as adjusted. So to give the similar example, the contract is for £1 million at tender when it's signed. After the contractor achieves completion after a year, inflation's been 10% over that year. You would look at it, it wouldn't necessarily be at 1.1, but you'd say when was the sort of money, you do a smooth line up and sort of how the money was spent to arrive at how much the final target prices is, and hence the pain gain against it. Historically, until a couple of years ago, 3-4 years ago now, you'd only start using this option for contracts of over 18 months, 2 years, something like that. But because of the recent surge in inflation, which fortunately is settling down now, it's been specified on shorter contracts because contractors have got very worried about inflation and losing their shirt. And this is how it works. You specify an indices. The normal ones are the BICSs, and BICS, I can't remember what it stands for, but it's a subsidiary of RICS. And basically, in the same way that ICE have Thomas Telford to make the money, RICS has a commercial arm, so the Royal Institute of Chartered Surveyors, and they publish this list. And you put in the proportions here, and you can have as many proportions as you like. But I would recommend you keep it simple, having looked at this. And often contractors are just, rather than going steel work and concrete and road costs and da 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 da, on a new road, we just did new build road costs, yeah, because essentially the proportions are a bit of a guess. The indices don't exactly correspond necessarily with how they're incurring costs. So, again, overcomplicating it just means it's a bit of a guess. The entries are the base date for indices, I would suggest, is when the contractor has to put the tender in. And the indices are who they're published by. So you put steel or new build road construction in there, and then you probably put BICS in there, these indices there. Changes in the law is an additional compensation event where any change in the law which occurs after the contract date and affects the contractor's costs becomes a compensation event. In the UK, this change in the law could be when an act of parliament is signed by King Charles. So it's not when the parliamentarians vote it in and say, we want this. It's when King Charles actually signs the act. For delegated bodies, it's when the law is changed by statute. So that could be a regional assembly, stroke government, so the Scottish Parliament or Welsh Assembly or the Northern Ireland one. It could be health and safety executive. So quite some time ago, the standards for doing structural steel changed from good practice, but basically became the law. And if the contractor was doing the lesser standard, then suddenly had to up their game, they would have been entitled to an additional cost. It's usually amended because it covers up here any change in the law. It's usually amended to restrict which changes in the law apply. And there needs to be a fairly direct link to apply to it. So contractors have wanted sort of, let's see, an act related to, I'm going to make this up, supplying arms to Ukraine or sanctions against Russia, causing cost inflation somewhere in the world, yeah, and wanting that to be entitled then to additional cost compensation event. The better example of a more recent one is red fuel, which didn't have VAT or other taxes on it, and that was abolished, and the contractors had to pay more tax on it, and therefore a direct change in the law in the UK directly caused more cost on diesel fuel, directly caused more cost on their sites. So that did apply. Final comment on it, which is not on here, is just be aware of contractors getting double bubble, as in they get a compensation event for the increase in fuel costs, and then inflation occurs, and they retrospectively get an increase, an adjustment to the prices for inflation, caused in part by the increase in red fuel. So that's normally taken into account when assessments are made under this. Multiple currencies allow a client to partly take risk of currency fluctuation for a specific item. And here's the entry. So you identify in the contract data, you identify the item or activity, which currency it's going to be paid for, and the total maximum payment in the currency. And that's why I say partly, because you could say this tunnel boring machine is going to cost the contractor £2 million or 2 million euros, shall we say. I will take it up to, as a client, up to €1 million. Therefore, the other €1 million, which might vary, etc., that's on the contractor. Which exchange rates are to be used? So who published them? Is it the Bank of England or Barclays or whatever? And this entry, I really don't get, and I've gone back and I've read the words in the clause. Well, actually, it's going to be at the time of the transaction, surely? And the words don't make it clear. So I'm not sure what the hell that entry there is for. Another one related to related to the what was the previous one? The multiple currencies as advance payment to the contractor. And the reason why I've put this together is let's say I'm buying that tunnel boring machine, and I have to put down a deposit a year before I actually move on to site with that tunnel boring machine manufacturer. Now, under NEC 3, it allowed the contractor to be reimbursed before the starting date. So the starting date is when the contract mechanisms all come alive. Yeah. So the contractor's moved on site. They've shown that the other party, their insurances are for doing the work, including design, etc., and so on. Payment mechanisms are up and running. A lot of the costs have to be incurred within the working areas or the site, etc., and so on. This allowed the contractor to say, I don't need to mobilise all of that. You, the client, don't need to mobilise all of that. Just make an advance payment for this deposit. And then advance payments were repaid in instalments as stated in the contract data, and normally after the starting date. So once the contract mechanisms had got going, and the employer could require a bond, which we'll come to, as a surety that if the contractor went bust, they would get the money back that they paid for it. In NEC 4, they changed it, and it's paid at an assessment date as per a normal payment. So all the contract mechanisms have to be up and running. Okay. So under an option A contract or B contract, as a contractor, I could just specify it as a normal activity. I'm going to put a down payment on the tunnel boring machine. It's going to be £1 million or €1 million. Pay me €1 million, right? Under a option C, D, or E contract, the cost-based contracts, I've paid out €1 million as a defined cost. We'll use I pay the bank for the conversion rate, whatever it is. It's a defined cost. You pay me. So what's the advance payment bit? So what's the point of having the facility? And the only thing that I can think of under NEC 4 is so that the client can get a bond, but it's not an advance payment to the contractor. It's the contract's up and running because of the way they've changed it. So I'm a bit mystified by X14 here. X4 is ultimate holding company guarantee, and in NEC 3 it was called the parent company guarantee. So what's this about then? So parent company's guarantee, or what it does is the parent company of a subsidiary effectively says, I underwrite any expenses you incur on this contract if this subsidiary closes down. So if the subsidiary gets into financial trouble, and it could be on that project going seriously wrong, or it could be on other projects going seriously wrong, the parent company can't just go, well, I'll just close the subsidiary down as a legal entity and hey, then I'm out of there. Yep, I'm all right. If they did that with a parent company guarantee, they would have liability to the client for the extra costs in getting someone else in and finishing off the works. Experience suggests that actually you don't want the ultimate holding company guarantee, because if it's a family firm, and I won't mention somewhere I know this is the case, but where all the assets are held in a trust in Bermuda, all right, getting the money off the Bermudan firm is going to be difficult, and by the time you get it, it will be moved to Jersey or wherever, or then Guernsey and so on. So often it's often modified or placed on the ultimate UK holding company, and if you're going to make a claim on it, you can actually get a court injunction to prevent assets being moved out of the UK to escape liability. The downside of this, from contractors, one reason why contractors don't like it is that the full value of it appears on their balance sheet. So if you look at contractors, their balance sheets are appalling generally, and therefore that means the city gives them a low price rating. And if you, one of the reasons why they're appalling, apart from contracting being a business with appalling economics, is that the full value has to appear on their balance sheet. So it looks like they're big in debt, basically. Okay. So when an investor looks at their balance sheet and goes, should I invest in this company? They look at it and they go, oh, or an unsophisticated investor, they look at it and they go, Jesus, they're up to their eyeballs in debt. I'm not investing in them. Okay. So that's what they are. The other tool for doing this is a performance bond. It serves the same purpose as a parent company guarantee, in that if the contractor, and it could be the contractor if you like, no subsidiary, but the actual one you're employing shuts down, becomes insolvent, then what happens is the contractor has taken out a bond with a financial company, and if they become insolvent, go out of business, then the client can claim on that financial organization for the value of the extra cost incurred, okay, as a result of having to get in another contractor to finish off the works. But financial companies don't just give out bonds, a form of insurance, for free. They charge, and ultimately that charge is going to be included in the prices somewhere. So the client is ultimately going to pay for this additional cost. Contractors may also have an issue getting the bonds from financial institutions, as in financial institutions will look at their overall liabilities. If this contractor goes down and says, well, you've got 10 out already, I'm not giving you another. So they have to wait, if you like, until another contract has, if you like, been finished before it opens up the financial organization to give a bond for that specific project and that specific client. So I hope you're getting the sense that everything has its pros and cons. So when we look at this, if we just close off this, we've looked at price adjustment for inflation. We looked at, well, we've closed off this slide basically. Okay. And if we go on to the next slide, we've also looked at undertakings, advance payment and undertakings to the, oh no, we haven't looked at that. I've just started advance payment, I think so. Right. So if we go to the top, we've got termination by the client. And what this allows to the client to do is to terminate for a reason not in the termination table of the core clauses, so not in section 9. So NEC, when it came out, was fairly unique in that it had termination provisions where the contract could be brought to an end early through the mechanisms of the contract. So rather than repudiate the contract and have a big argument under contract law about who was at fault and how much, it was defined these process or the reasons, and depending upon the reasons, define the process and the amount the contractor got paid. And if it was because you were the contractor was really awful and you followed the right procedure, they effectively, and you got another contractor in, they would effectively pay the extra costs. On the other hand, if you were throwing good money after bad and just decided to terminate the contract because it was no longer viable as a project, nothing to do with the contractor's performance, the contractor got paid their fee percentage on the remainder of the outstanding work for the original prices. For some reason, and that was all core, for some reason in NEC 4, they changed this so that this became an option. So it was taken out of the core clauses and put into X11 as an option. And it's sometimes called termination for any reason. Strictly speaking, as it say, it's termination for reason not listed in section 9. And my view is, why wouldn't you use this option if you're a client, or specify this option? Because it just gives you the option of terminating the contract if for some reason you've decided you're throwing good money after bad, yeah, you can still terminate for all the other reasons. You don't want to use it, but it gives you the option. Otherwise, you haven't actually got that option. So all the contracts I've been involved, NEC4 contracts, we've specified on that because why not? Yeah, gives us the option. Retention is X16, so it allows the client to retain monies as the contract progresses as an incentive to correct defects. As in, if you don't come back and correct defects, we'll take money from this fund. But when you achieve completion and at the end of the defect state, so typically a year after completion of the whole of the works, we'll pay back the remainder. Okay, so retention is much maligned with some justification because it's much abused. All right, as in people keep the money back and then go, oh yeah, but we're not actually going to pay you back. Or they keep the money back and then, as with ISG, they then go bankrupt or insolvent, yeah, and the people don't get the money and so on. So there is a fairly strong campaign to get rid of retention, and many before I do that, many repeat order clients aren't specifying retention anymore on the basis that the biggest incentive to a contractor is repeat order profitable work. And notice the profitable in there. It's not repeat order unprofitable work. So you need to be a sort of decent client, if you like. On average, contractors need to be making profit on your work. So repeat order, that's the biggest incentive, and therefore they don't use it anymore. On the other hand, I do have sympathy. I'll give one example of one contract. Is a council. It's £120 million a road around the north of a city. It was a big contract for them. They don't do that as standard. Therefore, they're employing new contractors rather than local ones. It was a national, arguably international contractor. They would have had no leverage on that contractor to come back and correct defects if it was defective. All right. So I do have sympathy with that. But if you're in an ongoing relationship with a contractor or a consultant, I would suggest getting rid of retention. What does the contract data entry look like? It looks like this. And retention percentage is normally specified at 3 or 5%. As I said, half of that is paid back on completion. Half of that is paid back at the end of the period for correcting defects, the defect state. NEC, when it came in, it introduced this retention-free amount. And in traditional retention is retained right from the word go. So first month, I'm paying you £100,000, retention's 5%. I'm actually paying you £95,000. But what's the point of retention? It's so you have money at the end to encourage the contractor to correct defects. So you only need it at the end, yeah. And if the contractors are not getting their full cash flow, they're financing it. And contractors, because their books look bad, yep, generally it costs them more to finance it than the client side. So the retention-free amount is where you say we're not going to deduct any retention until 80% of the price is reached. So exactly the same project that I'm talking about, the £120 million contract, they said something like 80%. And then we're going to deduct retention at 25%. And if you do the maths, that will mean that they'll end up with the same amount, 5%, at the end of the contract, which is when they want it. But in the meantime, the first 80% of value delivered, the contractor's not financing that lost cash flow. Okay, so that's what that's about there. And just point out, the contractor may give a retention bond. That is specified there. Gonzalo, I think your microphone's on, I think. X8 is undertakings to the client or others, and it used to be called collateral warranties. And it was only in the professional services contract for some reason in NEC. They changed the name to broaden the application by sector. So collateral warranties are sort of unique to construction, I understand it, and or the correction period. So I've talked about the defect state. The defect state, if I go back to the slide before, is typically a year after completion. And that's the time from completion that the contractor has a contractual obligation to come back and correct defects, right, in their work. So when I say extend the correction period, it could be for a specific thing that you identify in that collateral warranty that they have a specific obligation to come back over and above that default 1 year or 2 years or whatever it's specified in it. So, but I haven't said what a collateral warranty is. So if we look at this watch, and actually it's not this watch, it was my previous watch. My previous watch, it's a smart sports watch, I bought via the internet from an internet retailer. I didn't buy it from the manufacturer. When I opened the box, it said, register with Polar, bit of advertising, yeah, and we'll give you a warranty, a manufacturer's warranty. Now, when fortunately at month 23, my previous watch conked out, rather than going back to the internet reseller, I went straight to the manufacturer and said, your watch has conked out. Can you replace it under the manufacturer's warranty? A collateral warranty is similar in that it creates an obligation between two parties who aren't in contract. So it could be a supplier to a subcontractor or a subcontractor and the purchase of the finished asset. That should be ORA. Sorry, that should be ORA, that one word there. The other. So it could be, I'm a developer, I'm employing a main contractor to build it, who's employing a specialist subcontractor, mechanical and electrical contractor to do the ventilation system, who is buying kits from a ventilation manufacturer, a whole system, if you like, yeah. And at the end, I'm going to sell my building, because I'm a developer, to the end user. So we could put in place a collateral warranty, which goes from the purchaser of the completed building, and it could be expressed as that, all the way through to the manufacturer of that ventilation system. And if there's a problem, then rather than having to go through me, who you're in contract with because you bought the building off me, to the main contractor, to the subcontractor, to the manufacturer, you can go straight to the manufacturer to say, can you fix this? Okay. As I said, it also effectively allows the defect date to be extended for a particular component of the works. So more than that year or 2 years. And so here it is, the entries. I think it's actually missing. So the undertakings to the others would be perhaps the end user, you know, in my example, the person who the building was sold to, and that would be by the contractor, presumably. The subcontractor undertaking to others are, and this would be what they're doing, provided to. So that could be the M&E systems. The subcontractor direct to the undertakings to the client are these things here. So this could be, yeah, so on big contracts, you often see multiple collateral warranties put in place. Oops. Then we've got transfer of rights. So this is transfer of intellectual property, right? So stuff that people have developed for the contract. Without this option in here, the default is that the contractor or the consultant under the professional services contract owns that intellectual property. So what they've developed for this contract, that's the default. But what you can do is say, except for this, without this option. This switches it around and says, without a specific statement in the contract, in the scope, the client owns the right intellectual property to what's been developed. So let's do an example under the professional services contract. Let's say I employ a consultant and I'm in defence, and I employ them as the MOD to develop some weapons system which will blow up and kill lots of people. I don't want that to pay the consultant to develop that, and then they go, oh, we'll go and sell it to Russia, yeah, or commercialize it, whatever. If I'm paying for it, I want to own it, own the intellectual property to it. In which case, I put this one in, and the default becomes I own it unless I say otherwise in the scope. If I don't specify it, the default is the contractor owns it or the consultant owns it unless specified in the scope. Information modeling. In construction, this is building information modeling. Why the B? The B is left off because you have all sorts of data sets in the wider world. So I should have said, with undertakings to the client with this, one of the aims of the NEC 4 was to broaden the application of NEC, the contract, beyond just its traditional or established construction and heavy engineering set. So they changed some of the terminology, including, for instance, changing employer to client to make it broader. So if they were just aiming for construction, this would be called BIM. That should have a capital M, but they're not. They called it information modeling. It refers to the scope for detail, the technical documents, but includes provisions for, amongst other things, acceptance of the information acceptance plan. So how information is going to be developed and the model is going to be developed. Rights to ownership of the information model. It's the client. And liabilities for errors in it. If everybody who is involved in this project is contributing to it, then the default will be that the client owns it. So if a consultant's developing it and then the contractor's adding in information, but what the consultant's put in is defective, then if you like, it's the client's risk. Which brings me on to contractor's design. And you would want this in any contract where the contractor is responsible for any element of the design, which today is pretty much everything, because even though the contractor might not be doing an element of the design, Cameron, which option does this question apply to? Sorry. Got a question, Cameron.
That was X8 to do with warranties going through to subbies.
Okay. Does it require the end user to go to this? Yes, it would do. As in, if you've got a collateral warranty in place, it allows them to go to the supplier or subcontractor who's responsible. Does it? Oh, I see. Yeah, I see what you're getting at. Yeah, I think I'd go that it would depend upon the wording. The answer would be, if it was within the defect state, you could go to the contractor and say, "Oi, the ventilation system is not working. It's a defect. It's within the defect state that I've notified you. Fix it." Yeah. And the advantage of that is the contractor can't say, "Oh, or the danger of a collateral warranty is you go to the supplier who supplied the kit and they go, "Oh, it's not me, it's the subcontractor who installed it. That's why it's not worked." And you get this arguments over who's actually at fault. Up to the defect state, you could, and you probably would, just go to the contractor and say, "Look, the project which I employed you to deliver, this aspect's a defect, fix it." Yeah. And from your perspective as a client, you're not concerned whether it's the subcontractor or the supply of the manufacturer. It's just, it doesn't work. Once that defect state has finished, you, short of it being, it wouldn't be a defect under the contract, but the statute of limitations, it would be a claim under contract law. So that
So
really
that
would be where the
would
yeah
that be things like due skill and care, or
yeah
materials, workmanship?
yeah, that sort of thing. Yeah. Okay. You know, you really have cocked up to have a claim under that. It's not just
Mm.
a bit of I don't know, this paving stone has come loose. It's it's all the paving stones have come loose or something like that. Okay. Does that answer it,
Yep.
Cameron? Yeah.
Yes, it
Okay.
does. Thank
Yeah.
you.
Yeah. So preferred route within the defect state, go to the contractor. After that, you'd probably be looking to go direct, but you might have arguments over who was actually at fault. So, and thanks, Cameron, because you've given an excellent link to this one, right? Okay. When you said, are we getting involved in reasonable skill and care and all that and so on. So under NEC 3, this was called limitations of contractors' design to reasonable skill and care. And that's pretty much all it did. So what does that mean? If I'm a contractor, I am under the Sale of Goods Act, I'm actually supplying goods legally, and goods have to be fit for purpose in terms of their design, their workmanship, the materials used. But I'm a contractor and I can't get insurance for fitness for purpose for design. I can get it for the other two, but not design. And also I'm far likely to subcontract it out to a design consultant who cannot get insurance for fitness for purpose. They can only get it for reasonable skill and care. So as a consultant, I have a design assignment. I use a engineer who's got experience to do it. I follow all the design codes. I tick all the boxes on my ISO 9000, including having a more experienced engineer check it, etc. I've exercised reasonable skill and care. I give that to the contractor to build it. The contractor builds it exactly as per design. Let's say a bridge. It should stand up, but it doesn't, and it needs correcting. So up to the defect state, the year after completion typically, what does this mean? It means that if the contractor goes back and corrects it, then it's not their liability, right? Because it's due to the design, which means that actually it's a compensation event, because if it wasn't a compensation event, the cost would fall on the contractor. If it's in that statute of limitations, so up to 12 years, if signed as a deed, the contract, after completion, let's say this bridge, it's not just a minor defect, it's like the bridge is going to fall down, yeah? Without this in here, the contractor, you'd sue the contractor and say, my bridge is falling down, rebuild it at your expense. And the contractor would go, why is it falling down? Oh, it's the design. I'll go to the designers, and the designers would go, we exercise reasonable skill and care. Looks, here is all our records and ISO and everything like that. And the contractor would effectively be piggy in the middle. With this, it reduces the level of liability for down to the same level as the designers, so the contractor's not the piggy in the middle, if you like. Any contractor worth there with any commercial, I'm not even going, acumen is overstating it, will not contract without X15 in place if they've got any design on it. And what that's more, without this, it means that the project manager, and this is a common scenario, the project managers from a consultant organization who should have done the design, they haven't. So the project manager tries to add, so this isn't specified because the consultant should have done all the design, the client's consultant should have done all the design. The project manager then tries to add in design to the contractor to avoid blame falling on their own organization. Along with the definition of the works, the contractor is perfectly within their rights to say, that's not the basis on which I entered into this contract. It's outside my scope. I'm not doing it. Okay. So that's the same in NEC 4, but NEC4 also added in these other things which were missing and which lawyers were writing Z clauses, additional conditions of contract to cover. So use of the material generated, what it can be used for, as in it can be used for these works. A requirement to have professional indemnity insurance. Go up and up. The cap on the liability. So typically 5 or 10 million pounds for most big consultants. And if you're a consultant or a contractor, you want the cap on liability to match the maximum of your professional indemnity, because otherwise, let's say the claim is for 12 million, but your insurance is for 10 million. Well, that extra 2 million is on you. And requirement to keep documents for the period of retention. So it's in italics and stated in the contract data. So that's typically 12 years, because typically when we sign a contract in England and Wales and Northern Ireland, it's a 12-year limit from completion when people can sue us, if you like. In Scotland, it's 5 and 10 years. All right. When NEC4 came out and people started seeing period of retention of 12 years in it, you got people going, retention for 12 years? No way, I'm not signing that. And you had to sort of reassure them it's the documents that are being retained. So just a quick diversion, referencing the contractor's scope. If the contractor is doing work pre-contract and then putting forwards their design, so this could be in the early contractor stage 1, or it could be on a design and build contract. And you're saying as a client, part of what I'm going to select you on is what am I going to get for my money, if you like. And the contractor puts forwards their pre-contract design, as in the design they've done before contract. You want to absolutely make sure it's referenced in contract data part 2, the bit that filled in by the contractor, and put in this box. You don't want, as a client, either no reference to it, because then it's not part of the contract documents at all, or referenced from contract data part 1, because if it's referenced from contract data part 1, you'll have arguments over whose scope document it is. If it's referenced from contract data part 2, then the contractor becomes liable for any ambiguity or inconsistency within what they've produced and between it and the client scope. And that's a big change from the default law position of offer and acceptance. So under JCT and I think FIDIC, the default position is as per contract law, as in I'm a contractor, I've done some design, it's part of my offer together with the price. You accept my offer, you accept that design. Even if that design is not in accordance with your specifications, your client's requirements, you've accepted my submission and therefore it overwrites my requirements. NEC, because of some wording in 60.1 brackets 1, basically says any design done pre-contract by the contractor, if it's referenced here, has to comply with the client's requirement, the client's scope in NEC speak. And if it doesn't, the contractor has to correct what they've done in here to comply. So the cost, the risk falls on the contractor. So that's a really important point. Right, let's crack on and finishing it. We're looking all rightish. So what have we done? We have done all of these now, I think. Okay. And there. So while we're just doing that, any questions on what I've covered? Thanks to Cameron for asking the question, but any more questions on what we've covered? I am aware I'm going through a fair pace in order to try and get through everything. Going?
Yes, I've got a question.
Yep, Andrew.
Got a question, John. Generally, under the NEC, if a contractor goes bust, is there provision in the NEC to deal with that? I mean, we were just talking about these termination.
Yes. Well, so the most obvious one is if it was, you'd either have a parent company guarantee or a performance bond in place. Right.
Yeah.
And if the contractor went bust, you would, through the termination procedures, you would say, I am terminating because you've become insolvent, which is one of, there's about 7 reasons. The first 7 reasons are basically because the contractor has gone bust. Yeah. And
Yeah.
I don't understand the nuances between insolvent and an appointed administrator or whatever, but they're there. If that's the case, the procedure is the contractor stops work immediately, and the amount due is the contractor gets paid for the work that they've done so far, and costs committed, but minus the forecast costs of getting someone else in to finish off the works. And if the contractor's bust and can't pay it, then that's where the performance bond or parent company guarantee comes in.
But is that classed as termination by the client?
That would be termination by the client, yeah.
The client,
but
has
you'd have to follow the termination procedure.
Yeah,
to terminate it.
So it's not because the client decides, right, I want to terminate this contract necessarily. It's because the contractor has gone bust, but this is the way to follow it. Yeah. Okay.
Yeah. Okay.
Yeah. Good.
Okay. Yeah.
Good.
All right. So we're on to the last slide. So we're going to work our way through here. So first, I think actually, what I'm not actually, if it's out of the blue, I'll just talk through this slide. So because rather than do separate slides. So termination by either party is under the term services contract or term services subcontract. Effectively, what that allows is either party to get out of a contract early when it's not working for them. So that could be the contractor says, after a set period of time, I'm just losing money. I don't want to carry on. I'm going to give you an appalling service because I'll be losing money all the time. The client says, I don't like you. You're giving me an appalling service. I'm going to terminate. Okay. Whole life cost is where the contractor can come up with a suggestion where the client might wish to spend more in terms of capital on the actual project, but they will save money over the whole life of the OPEX phase, the operational phase. Good idea, you say. Couple of criticisms of it. Oh yeah, and the contractor gets some of the benefit of that. The problem I have with it is twofold. One is basically the contractor comes up with a suggestion, runs it by the project manager, and then they've got to, put forward proposals for how much money they're going to get as a share of the savings. So it seems remarkably vague on how any share of savings is calculated. And I can quite imagine, as you get with target cost contracts, where the contractor comes up with a whiz-o-whiz idea to save capex cost, project manager dismisses it, and then 3 months later has a remarkably similar idea and gets all the benefits of it on behalf of the client. I can quite see that happening with these suggestions, even more so. The other thing is, if you look at modern project management and value, and what value is, well, it's benefits over whole life cost. They seem to have lost the benefit bit. Yeah. So in terms of, I've come up with a whiz-o-whiz way on which I can improve the benefit derived from the project, not necessarily reducing the whole life cost, but your return on capital employed effectively is going to be better, however that benefit's expressed. I suppose the opposite of extending of termination by either party under the term services contract is extending the service period. So I'll just and you could do that by agreement in any case, a supplementary agreement between the directors. Putting that in there is effectively signposting to the contractor that if we're happy with you, instead of it being for 4 years, it could be 8 years. Right. And if you're running a competition under procurement law, having that facility in there already complies with, if you like, the reasons for why you're running the competition and the basis for competition, because the service period is such a fundamental of a term service contract that signaling that it can be extended is quite important, is, you know, really valuable. X24, the accounting period, also applies to the term services contract. What this allows you to do is say we're effectively going to close down each year's accounts on 31st March, say. And once we've final accounted it, that can't be revisited. And the advantage for both parties, therefore, is that if you're a company who wants to go to the city and say our profits are this, yeah, if the account has been closed down and can't be reopened for that year, you can do that. Right. Okay. Right. Okay. Just answer some questions while they're here. Would a consultant's design to reasonable skill and care be contained with the next clause in the PSC contract? The answer is no. I'm pretty certain it will be a core clause. So if we go X15 contracted design, yeah, it's a core clause in the professional services contract. And we've got some apologies for leaving early. Supplier warranties. We've talked about warranties. These are direct with the supplier and the alliance contract. Program of work is on the alliance contract, and this came about, and I have a bit of direct experience. Basically, I was helping the Highways Agency, I think it was still called the Highways Agency, when they were developing their alliance arrangements for smart motorways. And at the time, only the consultative version of the alliance contract was out, and only 450 million pounds worth of work was defined enough to be included in the contract. But they said what we want to do is add in an extra 4 billion over the course of the alliance as one contract. So very quickly the panel came up with X26 for a program of work to add in to the same contract more and more. Just take that. It's half a page long, the program of work. Yes, it does refer to the scope for the detail of how, for instance, the extra bits are added in and the procedures and how the amounts to the change to the alliance budget are calculated. But half a page for £4 billion worth of work is a bit brief in my view. So if I was going to use that, it might be to add a bit to the alliance, but not that extent. So done that. Okay. And then we're going to go on to these, which is the next slide. So first of all, I should have said on this slide, why UK? Why UK? Because these bits of clauses only work if you're in the United Kingdom, as in there's legislation in the UK. You either have to have them for this one, or they only work with UK legislation. They don't work abroad. So what's why UK 1? Oops. It's the project bank account. You don't have to have it. How does it work? A separate bank account is set up into which all client payments are made, including to the contractor. So they have to go via a bank account to the contractor. Payments are made out of it direct to the contractor and down the supply chain to name some suppliers. So the money doesn't go through the contractor. And when I say down the supply chain, that can be not just second tier, as in subcontractors, it can be third and fourth tier. The client and the contractor are the trustees of that project bank account and therefore have a fiduciary duty to act in the best interest of the beneficiaries, which are the named suppliers as well as the contractor, right? But not to put the contractor ahead of all the others. Right? So that's how it works. And when I say a fiduciary duty, basically, if you don't do that, put their interests ahead of, at the front, and you've acted in your interests, then it's a criminal offence, right? And so you could go to jail for it, and you could be sued for it, and so on. So what happens is, what's the advantages of this? Well, It protects the supply chain in case of the employing party. So let's be topical. If ISG, on the ISG contracts where this was in place, the money would be in the project bank account. It would go to the supply chain, the tier 2s and the tier 3s, all right, rather than going to ISG and then the bank says we're closing you down and the bank gets it. So it protects money down the supply chain. During the contract, it generally leads to faster payment because the money goes in and there's much less incentive for it to be hung on to, because it's often the people at the involved in the contract who actually certify the payment. So the contractor normally administrates it rather than the payments department who hang on for as long as possible. It goes down the supply chain, so it speeds up payment down the supply chain. And then the other thing is there's transparency of that the payments have been made. So let's say I'm a client and I want to have a KPI pay against faster payments down the supply chain. I can just look in that bank account if I've got access, or I get a report from it, rather than saying, can I have access to your company bank account? Get lost, yeah, or getting a filtered report or whatever. And that is even more useful under cost-based contracts, because the client can say, I've paid this money in, have you paid it out? Yes, you have, I can see it. And with JVs, for instance, where the joint ventures, where you don't want to be looking at two company accounts and two different procedures, there's just this bank account, and again you can it's paid into that bank account, and as well as being distributed down the supply chain, it's also paid out to the JVs, the 2 or 3 contractors who form part of that joint venture. And it used to be when we first set this up for Connect Plus, banks didn't have a clue. No one had a clue. Whereas now it's a fairly standardized product once you get to the right level. Often it is set up at framework level. And by that, I mean, I'm a client. I've selected you under a framework. I have 5 years of work. Multiple contracts might be going at one time. I don't want to be setting up a new project bank account for every single contract. So what I've done is effectively move these clauses to framework level, and we've set up at a framework level the bank account. Last comment on this, this makes the project bank account a trust fund. I know of big projects where a project bank account has been set up with a JV just because on a cost-based contract. I should have said it under here, because it just makes it easier, yeah, to account for the money, follow the money, etc., and so on. So you don't need to have trustees. You'd have to cross out words in NYUK1, but you could just have a project bank account without the trustees. Housing Grants Construction Regeneration Act, same piece of legislation that makes adjudication in the UK compulsory, also says that a contract for construction operations, and it defines what those construction operations are, has to have certain payment provisions which comply with the Act. If it doesn't, then a thing called the Scheme for Construction Contracts applies, which is fairly badly written from what I gather. In the UK, it's rare that YUK2 is not used. It is often amended to some extent, and especially the timescales are amended. So here's my standard diagram. So the NEC has an assessment date. So this is under options A and B, where activities complete, work done up to it. Under the option C, D and E, if we go forwards to the next assessment date, it's the forecast of money they will have spent. The date due is when the project manager on the client's behalf has to certify the payment. And the final date for payment is when they have to have paid for it, paid out this money certified by the project manager, except if before the start of the prescribed period, the client says, I think my project manager's got it wrong. just slightly broader context. The project manager has to give consider any application by the contractor and state the basis for an assessment. A wise project manager would also state why they're not paying what the contractors applied, if that's the case. So you applied for £100,000 because you said you had completed 10 activities worth £10,000. I am not paying I'm paying you £90,000 and deducting £10,000 from your application because you have not completed this activity in accordance with the contract. So not just state how it's built up, but also state, if you're knocking it down a bit, the reason why. Likewise, if the client is going to reduce that assessment of the project manager, they need to state the reason why they're reducing it. And it needs to be, there's case law on JCT, I think it was, where the client just tried to sort of deduct money because they felt like it. And the judge basically said it's got to be a reason of substance in accordance with the contract. Now, all these timescales, these 3 timescales can be modified by agreement. If you went over 60 days, probably that doesn't comply with the Fair, Fair Contracts Act, something like Fair Payment Act, something like that. The one act timescale which is enshrined in the Act and you can't pay a change is this 7 days. So if the employer doesn't, or the client doesn't pay, or doesn't pay that £100,000, pays £99,999, the contractor has a right to suspend performance, but they have to give 7 days notice. And if it's paid up, then they don't suspend performance. Okay. It's rarely used because it's a winner takes all, as in if the contractor uses it correctly, they get a compensation event for demobilizing, doing nothing, remobilizing, time and cost. If they get it wrong, it's all on them. So I've only heard of it being used 3 times. Contracts rights of third party was brought in to try and reduce the reliance on collateral warranties. Without this act specified in the UK, any third party who gets a benefit from the contract can either enforce that term, so go to the courts and get the courts to say do it, or sue the contractor directly for not doing it. Therefore, a contractor doing a work in the public realm, so where there's lots of interactions with the public, access routes, reinstatements, etc., could be sued from all angles if they don't, well, even if they perform the contract and Joe Public thinks that they haven't performed. So this is a clause to opt out of the act, but it allows for an opt back in for a specific term and beneficiary. So let me explain that. If you specify this option and you don't have anything written here, it's a complete opt out of that act. So no third party can sue the contractor for a benefit which they get under the contract, which is between the client and the contractor. But if a term is put in here and the person is stated there, then they can. So without any entry here, it's a complete opt-out, but you can opt back in for a specific term and a specific party to benefit from it. And down here, if YUK3 is used, the provisions of the options YUK1, the named suppliers. So if the contractor doesn't behave in accordance with that act, that trust fund, they can be sued for it by the named suppliers. So we've done these 3. Last one, additional conditions of contract. You might not get this, but it makes me laugh when you've seen the amount of guff written in Z clauses. They really are a lot nonsensical. A lot of what I read and review. Excessive use of option Z clauses. Many are simply not needed. Contract covers it already or should be in the scope. Many undermine the big picture intent of the contract. So the client says we want a collaborative procurement route. At a big picture, it's done, and then the lawyers write in loads of nasty stuff, which undermines the collaboration or cooperative ethos, I should say. Especially when you think through the second and third order effects of it. And many of it are just poorly written, create ambiguity and inconsistency, which ultimately, if they're not resolved by other rules or principles of interpretation, actually put the risk back on the client, but after a big argument. Well, that's not good for dealing with risk and managing risk. So experienced clients generally reducing them writing better ones. As one contractor said to me, clients don't write lots of option Z clauses and take back lots of risk. They generally write option Z clauses, or lawyers certainly do, to put risk on the contractor. And it can be this brutal from contractors. They look at the contract, they look at the number of Z clauses and just go, not bidding. All right. Or they look at them and go, don't like that, don't like that. There's quite a lot of risk in here on us, including risk of an argument. Yeah. We've got clients who we prefer. So control your lawyers, project manage your lawyers. I'll stop my rant there. Just what I hope you see, again, this is the full ones, principles of risk allocation, is how almost everything we've covered is to do with risk allocation. I hope you see it's just a reminder of this process, and where we are is sort of almost down here. And the last one there, and we've talked about when we've looked at the entries in the contract data, you know, the thresholds for liabilities, the remedy amounts, etc. Those are significantly affect risk perception. And the last one is just on adjusting risks. And that is where you can add or delete compensation events. So you can delete compensation events through the Z clauses in the contract. All right. And if it's not a compensation event, then it's a contractor risk. It's within the prices. You can add or allocate a risk to the client, either as additional compensation events or as additional client's liabilities in the contract data part 1. And here are the two entries, which are actually next to each other. I did overlap them slightly to get it on the slide, but they're actually next to each other. And you can just put in additional compensation events. Where you typically see that, or most commonly you see that, or saw that, was an operational facility. So a real life example, a port, which is about an hour's drive up from Dublin. It's an overflow port stroke cheap port alternative. And they were putting in an extra berth for an extra ship. I think it only took 2 ships and they wanted it to take 3. The contractor needed to allow for a certain number of ship movements in and out per month, because they basically had to stop work when a ship was coming in or going out. And I can't remember what number it was, but if it was more than that, then it was a compensation event. Okay. More recently, COVID type risks have been added in here, and so on. So I hope that's it. We've done that. I hope you feel much better able to do that. Intelligently contribute to a good development of a good contract strategy, or as a contractor or consultant go, whoa, hang on, what the hell's that about? Okay. So with that, any final questions? Any biggest aha moments and any endorsements, as in something which I can take off from the chat and advertise myself with? I always like them. Right. So any comments, anything you want to add, please put in. Otherwise, I'll just stay on here for a little while until everybody signs off.